Hello, everyone. If you're unfamiliar with who I am, my name is John Darcy. I am a partner working on big business development activities here at SkyBridge. I'm also the managing director of SALT, which is our global leadership series, thought leadership series with events in New York, in Singapore, in Abu Dhabi. And then our most recent event was in the Bahamas that was focused exclusively on digital assets, which we hosted in partnership with FTX, a firm that if you're involved or paying attention to the digital asset space, you probably heard that name, and we'll talk about them a little bit later. Given our close relationship with FTX, I think have some unique insights there. But it's a pleasure to have you back on the SkyBridge Bitcoin Review. We're wanting to do these more often going forward for a number of reasons. One, we generally like communicating with our clients and partners and friends, and also because at a time when markets are particularly volatile, we like to over communicate and make sure people are comfortable and understanding at least what's happening within the marketplace. But I'm pleased to be joined again today by John Svolos, who is the SkyBridge head of cryptocurrency research, as well as Brett Messing, who is the SkyBridge co-CIO, president, and COO as well. Fellas, it's great to have you back on the SkyBridge Bitcoin Review. I just want to remind our viewers as well, we want this to be very interactive. So please, there is a Q&A box at the bottom of your video screen. There is a chat box. If you have any questions or comments, please post them there. We'll try to get to as many questions as we can over the course of today's show. If there's a question that you would prefer to ask in a more private setting, please feel free to email us at ir@skybridge.com. Again, that's ir@skybridge.com. And we can provide a very thorough answer to any questions there. But Brett, let me start with you. Last week, we talked sort of in the throes of the sharp sell-off that we've seen in crypto markets. You know, a lot of it could be blamed on macro headwinds, but those macro headwinds also created some sort of contagion effects and liquidations in crypto markets that centered around, weeks ago or months ago, we had Luna, Terra. It's hard to even think about how long ago it was, but that was the first sort of systemic meltdown that we saw within crypto. We saw Celsius, one of the leading crypto lenders, start to melt down. And then we saw basically the implosion of a hedge fund, Three Arrows Capital. But Brett, let's start with just the price action, the way you're observing crypto markets today. We've had a little bit of bounce in Bitcoin and Ethereum and basically all tokens. Do you think the bleeding has stopped, permanently? Do you think we've put in a bottom, or do you think we're going through just a period of lower volatility to digest some of the recent price action?
I want to get to that. I guess I want to start with, I know how this is the Bitcoin Review we call it. So let's just sort of talk about Bitcoin, which, on Saturday plunged into the 17,000s before sort of bouncing. And, you have to reassess your investment thesis. You're confronted with, are you wrong? I mean, and I've been our chief Bitcoin cheerleader, and nothing has changed about Bitcoin. Bitcoin is operating fine. The case for Bitcoin, particularly again, given the weaponization of the financial system as part of what's happened in Europe with the war, just sort of the mishandling of monetary policy, by, central banks around the globe, has made the idea, right, of a non-sovereign currency, digital asset, store of value, whatever you're going to call it, with sort of a transparent monetary, policy that's, based on math. I think that case has just gotten stronger. And even with the volatility, you can look at on-chain data and see that the number of people that own Bitcoin is growing, right? So, you're getting increased adoption in the face of this. So I don't think we're wrong, even though we're losing a lot of money and it's really unpleasant. The damage that has been done is sort of to players in the ecosystem. And I think I said this last week, and I didn't appreciate the significance of it, but Mike Novogratz compared the Three Arrows, it's going to be a bankruptcy. I imagine the guys who run it are looking for a non-extradition treaty nation right now. And I'm not even joking. He called it, crypto's long-term capital moment. And it's that, and it's more. And the amount of damage that was inflicted because they were a gold standard investment manager in the space. And I think they were People were lending them money on very liberal terms, often unsecured. Today, there was a public company based in Canada called Voyager Digital that announced that, they basically have an unsecured $600 million loan to Three Arrows, which is the hedge fund, and it's probably going to take them down. And we'll get to what's going on with them later when we talk about FTX's activities. But there's just been this sort of a contagion effect. And, BlockFi's had problems. We talked about Celsius. I guess it's just similar to what happened in '08, I guess, which is I don't think I understood how intertwined a lot of the ecosystem was. I mean, you even have, we've heard about these protocol teams. So someone does a funding and they raise $50 million to build out a new protocol, and then they give it to Three Arrows, right, to do their treasury management. Now that's gone, just completely gone. So you're going to see these protocol teams sort of shutting down. Now, that's not systemic at all. But it's a very interesting time. My mental model, back to your original question on the prices, I think we are very near the end of this sort of pain, but I am prepared for one more sort of swoosh, down. So call it 20,000 to 15 sharply, flush out anyone who's leveraged, anyone with a weak business model. We bounce into the 20s, could be 28, could be 22, and then we sort of languish for 6 months. And gratefully, it gets boring for a while, because boring would be nice, given everything going on in the world. So I'm not ready to call bottom, but I don't think, if you believe in Bitcoin, you don't get to buy bottom. So I wouldn't be too cute. I would definitely be thinking about, adding average cost dollaring. We're close to the bottom. I don't know, John, what do you think?
I think you summarized it well. What we have is an environment that's shaking out leverage, shaking out some malfeasance, and is bringing us back to the core question of whether this is an authentic event. And we believe that it's a generational technology transition. And what we now have is a really, opportune time to reset our expectations around valuations and make investment decisions that exploit it. The dynamics around, the end of the global asset bubbles and the unforeseen impacts that happened to the decentralized finance ecosystem and crypto, are running their course, but the broader secular trend is intact. So we're focused on that.
What do you think, John?
What do I think? I tend to agree with you, Brett, that I just, given the current macro environment that we're in, where it seems like the world could get significantly uglier in the next 12 to 18 months, I think unless you see crypto assets start to decouple from global risk assets, I don't think that we've seen a bottom in global risk assets or a bottom in general. I think we're probably heading into some type of a recession. I think you could see inflation persist as global supply chain disruption, especially around energy and food, continues to remain high. But I do think, we saw some, I think it's underestimated the level of liquidation that we saw with someone like Three Arrows. I mean, Three Arrows was a multi-billion-dollar hedge fund, and as we're seeing, had massive amounts of leverage based on the amount of money they owe to certain counterparties. So I do think we could trickle lower. I don't think it'll necessarily be with the velocity that we saw the recent sell-off, but I generally believe we'll probably bounce around in a lower range for a period of time, continue to shake out some leverage in the system before beginning the next leg higher. But I think probably most of the acceleration of the downside, I think, is over. And I had breakfast this morning with a smart young man named Will Clemente, who has done on-chain analysis with Anthony Pompliano and does it independently, as a great Twitter account with 600,000 plus followers. And he was just observing that, the fundamentals in terms of the breadth of adoption, the number of wallets that are coming on chains, diamond hands that are sort of accumulating Bitcoin, all those sort of fundamental metrics, if you can call metrics around Bitcoin fundamental, continue to improve. So he was sort of the belief of what I was describing, which is that, bounce around in a lower range before consolidating and moving higher. But let's talk about Three Arrows, Brett. So you mentioned the idea that the guys who ran Three Arrows might be looking for domicile in a country without extradition treaties to the United States. We're on sort of a private Zoom call here, and we can talk maybe a little bit more freely than we would openly in the media. But it sounds like from our conversations with some of their counterparties, we've seen some of them out into the open, like Voyager, when they got the bailout from FTX, basically disclosed hundreds of millions of dollars worth of money that's owed to them by Voyager. Several other counterparties, numbers in the hundreds of millions in terms of money they're owed. What do you make of that situation? What lessons can be learned from it? And are we out of the woods in terms of sort of the contagion effect of the blow up of Three Arrows?
I don't know, and I don't know to the last two parts of it. Look, people are going to go after them. What's shocking was that Voyager's, Voyager said that they owe them $600 million and they're going to be suing them. Genesis, which is, one of the largest traders and lenders in the crypto space, announced that they had exposure. They didn't name Three Arrows in a tweet, but they essentially named Three Arrows. And they made it clear that the sale of the collateral didn't cover the liability and that they would be seeking recoupment. I have on very good sources, a little rumor mog here because you said it's a private, that there are market participants that have gone to the FBI because they believe that there's been malfeasance on the part of Three Arrows. So, I think that this story is going to go on for a while and probably make a great book or movie, 5 years from now. There's a great book on Silk Road, by the way, for anyone who's interested. An earlier chapter in Bitcoin sort of history, very, very early. But I think the thing that has interested me is the amount of unsecured lending that was done. And, I think that, Three Arrows was viewed so highly, and clearly, again, back to the FBI referral. I mean, maybe misrepresentations were made with respect to assets. But one of the great things about crypto is, right, it's a 24/7, 365 market, right? If you take possession of someone's collateral, even with the volatility, you can liquidate it. And so it's been a little surprising to me that some large players have suffered such big losses. And I almost think, and we often see this, it's sort of a failure to imagine, right? And I think it was this failure to imagine that Three Arrows could go under that led people to do things that were reckless. I do think it's another indication, and we've said this before, and this, we try to be crypto hip, and this may make us not as crypto hip. Regulation will be good, right, for Bitcoin and for the crypto industry, right? So, most of the problems involve non-regulated entities. And
centralized entities. It's not like some of these DeFi protocols like Aave or Uniswap are somehow breaking and failing and causing this cascade. These are centralized entities that, because they weren't properly regulated, were allowed to engage in malfeasance or unsecured lending. And if there were rules in place, and this potentially wouldn't have happened, no?
Yes. No, I think that's right. And I think what you'll probably see, and some of this exists on Wall Street, is I think you're going to see better communication among the large participants about exposures, right? Because I have a feeling that we're going to find out that Three Arrows was, taking the same collateral and getting a variety of people to lend against it. And various people didn't realize how exposed they were. And so I think just greater communication, by the larger players will correct, solve for this. I don't think there's enough distance from 3 hours' failure, which is about a week or so, 10 days, that we can yet say we're out of the woods. I've sort of looked across the landscape and said, like, what's the next sort of domino? I don't see it. There'll probably be smaller ones. But again, as I said in my earlier comments, the interconnectivity of the ecosystem, I guess it shouldn't surprise me, but it has surprised me. It's funny, I was talking to someone and saying, what's the next domino to fall, or what's going to happen? He's like, well, are you looking for a positive catalyst? And I said, I'm actually not. Having lived through these kind of markets, if we could get through a couple of weeks without bad news, the market will go up. You know what I mean? I think everyone is so on edge that, I just like to get us to the place where we can comfortably say that we think we've seen certainly anything large that would come out of this. And I just don't think enough time has passed yet. I know, John, you have thoughts on that?
I guess you could look at it in a variety of ways. One, we certainly can't anticipate something that's not obvious or not visible yet. And there's layers of leverage that have emerged as we've unwound Celsius and Terra Luna and now Three Arrows. And there's also a sort of an informality to the ecosystem that I didn't anticipate. I didn't expect to see with respect to the, unsecured counterparty risk. And we've heard of other examples of it that are a little bit, unnerving. And I guess the process by which all of that is now going to be more rigorous, right, is going to be good for the whole ecosystem. But then to John's point about the broader market, it's really hard to say what's going to happen in the broader market. I'm, of the view that inflation expectations are already coming down and that the underlying risks to the global economy are still more deflationary than people realize. That's my own personal view. The 10-year break-even is back down to 255, which is in shouting distance of the upper range that the Fed has traditionally targeted. Oil prices are down to 106, and as Brett can tell you, they have a habit of moving well ahead of expected fundamentals. The, slack in the supply chain tends to reemerge when demand slows, and you find out there's been a fair amount of restocking of inventories by people who've been worried about it. I'm in the camp that the entire episode is going to end sooner than expected. I don't know whether it's going to end in a colossal, theatrical event, or we're just going to realize that the demand slowdown has already redressed the issues that were besetting us. But I do think we're further down the road than some other people have espoused.
So talking about FTX, so FTX has been sort of at the center of the action over the last week as the lender of last resort. Some people have joked that they've become sort of the Fed of the crypto market. Anthony said on CNBC the other day that Sam Bankman-Fried is sort of like the John Pierpont Morgan, who in the banking crisis of 1907, before the Federal Reserve even existed, was bailing out entities in order to both protect the American economy as well as protect his own interests. But Brett, let's start with you. Why do you think FTX is stepping in the way they have to basically provide credit lines and save companies like Voyager and then BlockFi?
Well, let's put quotes around the word save, right? So, BlockFi and Voyager are in very challenged financials. This has been in the media. We're not, and in Voyager's case, right, they're a public company. They've told us, in a press release this morning. It seems to me and to others that FTX is offering them enough money to survive, but not to stay alive. And that is essentially, it is a lend to own strategy, right? So they lend them money, they keep them from going under. It allows them to concurrently do diligence of these companies. And, financial services companies are very complicated. So it's not the kind of thing that you can do a deal over a weekend on. But what these companies have, they got messed up balance sheets, but they actually have a lot of customers. So both BlockFi and Voyager have over 1 million customers, meaning funded accounts, like not just downloaded apps, like people that have accounts with assets in them. It might be lower now, right? People hopefully wisely redeemed, but whatever it is, it's a big number. And so what has FTX been doing? They have been trying to grow their user base. Super Bowl ads, naming the Miami Heat arena, umpire, sponsorship, in baseball. They're on Lewis Hamilton's car, So, there's obviously in any kind of marketing, there's a calculation of what's the cost to acquisition per customer. And I think what they've determined is that, by buying these sort of, at least in the case of BlockFi and Voyager, assuming that they ultimately end up acquiring these businesses, that they will be acquiring customers for considerably less than what it costs to try to buy them via advertising. So I think they're being very opportunistic in that way. And I think, concurrently, look, they're a major player in the ecosystem. And to Anthony's point, avoiding a meltdown, being JP Morgan and stabilizing things has value to many of their other businesses. So, it doesn't sort of set the industry back. Look, the industry is unstoppable, but we could get set back for a period of time if there's too much damage done. So I think there's a number of things motivating FTX, but I think it is primarily to get their hands on these customers. John, do you agree, disagree?
I think your characterization's accurate. The weak are going to be damaged more than in this sell-off. I don't know that I have a lot to add beyond that. FTX is clearly one of the better run, more profitable companies in the space and is both interested in stabilizing it and opportunistic, really thoughtful about how they deploy their capital. I don't mean to sort of go in a different direction, but this is, as we discussed last week, right, when we were focused on Celsius and we were focused on Terra Luna, and now we're focused on Three Arrows. It's important to understand what's happening as it affects all of the assets and the asset class, but it really is more important to try to figure out whether there's something worth investing here in the long run. And day to day, that's where we're spending most of our time. And the outlook for that is unchanged. I mean, that's what I've been really focused on. Does that make sense?
No, I think that makes a lot of sense. And, I think from a technology standpoint, as I said, Bitcoin just keeps working, right? There's been, the Bitcoin network is just working. The Ethereum network continues to just operate. That's really where we're invested, is primarily Bitcoin, secondarily Ethereum. And as you sort of said, the stronger are going to benefit. To the extent that there's investment, I think it will be at the top of the ecosystem, again, primarily Bitcoin and Ethereum. And as capital, when it comes back into the ecosystem, no one's going to want to buy coin number 49, right? Or Avalanche or Cosmos. Like, if anyone on this call has heard of those names, highly respected teams, right? Interesting technology, but like new investors will want to have no part in that. They'll want to buy some Bitcoin and ETH and maybe some of John's NFTs.
Yeah, please. Moving on to the next topic. So one of the things that we have been discussing a lot internally, we both have exposure to liquid tokens as well as venture investments in the space. So obviously, you've seen the liquid token market sell off, more price discovery available in those markets, obviously. But everyone's sort of watching what was a really hot private investment market for crypto companies to see when the first signs of stress will start to reveal themselves. And so there's certainly companies with higher burn rates that are going to need to raise more capital, that are more prone potentially to down rounds. And you've seen companies like BlockFi undergoing idiosyncratic stress that have tried to raise money at lower valuations. In this case, BlockFi tried to raise at $1 billion, was unsuccessful, thus took the credit line from FTX, is now trying to sort out their funding needs. We also saw a company today, FalconX, raise money doubling their previous valuation. They raised $150 million at an $8 billion valuation. John Svolos, we'll start with you on this one. Why do you think FalconX in this current environment was able to double their valuation, raise that volume of capital? Do you think they are a special case where they're just that great of a company that they're able to continue raising capital at that rate? Or do you think you're going to see sort of a bifurcation of the liquid token market and private investment market for crypto-based companies?
I think that the two are going to move hand in hand, and I think that company has performed substantially. And merits the valuation that it achieved, just as we saw with Starkware and, other premier companies. FTX falls into that category that are distinguishing themselves because of the success of their business model. What happens is that the long tail of companies that, have less compelling performance characteristics find it harder and harder to raise capital. Not what we track in watching the investment flow into the private equity market suggests that the dry powder that we know is there is still active. And one of the reasons we really like the space is because we believe it will continue to be so, because none of the structural bull case has been damaged by what's happened. And a lot of the venture capital community sat on dry powder because valuations were so unattractive. It's just that the quality standard has changed. The valuations are a byproduct of the fundamentals of the company. But what we're hearing is that for earlier stage companies in particular, the valuations have come down substantially. It's much easier to get a board seat. You get a much more, traditional due diligence process. We're well past the frothy period in the fall when you were told you had 24 hours to make a decision and you had to commit capital or you were going to get squeezed out. And the companies that were aggressive at that time, have been carried to the woodshed. So we're in a more normal environment, and it doesn't exclude any company that's performing well from achieving a higher valuation. And that's what happened with Falcon. Does that make sense?
Brett, do you agree with John's assessment? We also saw Binance reports that they might do an extension of their prior round, not technically a new round, but would be an extension of their prior round at the same valuation.
Right.
Do you think we're going to see bifurcation in private investments, or just a few standouts that are able to continue to raise capital at higher or equal valuations?
I do think we'll see bifurcation based on burn rate and growth. I think that'll be important. On the Falcon, I'm gonna hold off on, I guess, spiking the football on that one, because what I think might be happening there, and I hope you're right, John, is I bet it's possible that the people who are investing in it agreed to the price 3 months ago and it's closing today. And everyone just sort of, we agreed on this price. Our reputation's important to us. We're going to close. I mean, I can tell you that at SkyBridge, there's a transaction that we agreed to with other, and I don't want to talk about what the investment is or who our partners were, but with, leading participants in the crypto sector. We agreed on a transaction at the end of November. We closed at the end of January. And the day we closed, we all knew it was the wrong price. But we like the business and we think we'll win on the business, but it just was the wrong price on the day that we closed. So this might be that. I'd like to see a few more. But it's certainly encouraging. It's not bad news. I'm just not sure if we can draw a conclusion. I'd like to see a bigger data set, I guess is what I would say.
Sure. We have a question. I want to go to some questions in the chat box, but one is about helium. Doug asked what our current thoughts are on helium, which is now called Nova Labs. Both the company as well as the token. Helium recently made a major change to the token, are allowing 5G, Wi-Fi, VPN to be integrated into their network. Maybe John Spolos, you take this, talk about our current view about helium.
This is what I love to talk about. All this stuff that we are forced to talk about that has really clouded the ecosystem with debris is leaving a lot of the bull case hidden behind it. And helium is a great example of what's evolving and what's so promising. So what they've done is they've used the helium token as a mechanism to support two different radio technologies with their own token, where the demand for those radio technologies flows through the helium token, and the proof of coverage for each of the radio technologies flows through the token associated with the technology. So one is an Internet of Things technology, another one's 5G. Radio technologies evolve. There are others. And it's also important to recognize that this is a global phenomenon and that the applicability of different radio technologies in different markets depends on the development stage of those economies, right? So if you're in an economy where it's very uncommon to have broadband, then facilitating broadband using some kind of Wi-Fi or 5G, distributed deployment can be a huge deal. And I think what's so exciting about what Helium's doing is they're creating a platform for radio technologies to be supported independently and across geographies. And it's really important to stop and just pause for a moment, because that's never been done before. Nothing like that has ever occurred. Every radio technology has been really idiosyncratic to the community in which it's been deployed. Every build out has been national in nature. There's really never been anything that managed to cross borders and achieve this kind of scale and to do it without any deployment of centralized capital. That's a significant event. And the reason it's so significant is because it's also the model for the deployment of similar architectures across all kinds of different markets that we could talk about at great length. And I think it's still unappreciated about the nature of this technology transition. That's what I always like to say in these calls. And that's why I always try to skip past some of the debris to get to it.
Brett, what are your thoughts on helium?
John's our helium expert, so I really, I don't have much I could add.
Well, I've got a question. This is my own question related to some news this week that we saw, but it's around Bitcoin mining. So we saw some news today that at least one of the Bitcoin mining companies has decided to abandon their HODL strategy, which was Bitcoin they were mining. They were holding it on their balance sheet rather than selling it into the marketplace. They've determined that for risk management purposes, and some of these mining companies have some debt, but they need to start selling Bitcoin into the marketplace. Are you worried at all about that adding additional downward pressure onto the price of Bitcoin, or do you think the market will be able to absorb it?
So this is what I like to quote the great Mike Tyson. Everyone has a plan until they get punched in the face. Look, one of the positives last year. So again, I really test my thesis, and so I have a list of like the positive things that have happened to Bitcoin, the negative things. Again, it's not about Bitcoin; it's about the ecosystem and people involved in it. And one of the things on one of these calls last year, maybe more than one, that we talked about as a positive was that Bitcoin miners, instead of, as they have, because until 2 years ago, there wasn't such thing as a publicly traded Bitcoin mining company. They were all private companies. They were pretty much self-financed. So they would mine Bitcoin and they would sell the Bitcoin, right, to get cash, to buy additional machines and to grow their businesses. And so there was this sort of constant supply that came on the market, from the miners as part of sort of the mining process. Last year, following Michael Saylor's lead at MicroStrategy, most of the public miners, and now they represent, something like 20% or so of total global hash rate. Most of them started this strategy of holding their Bitcoin. And the idea was that they would finance themselves through debt and equity in the public markets. Well, as everyone's well aware, the public markets have gotten crushed. Cryptocurrencies have gotten crushed. And the Bitcoin miners are down way more than Bitcoin is. And so they are in survival mode. And, when you're in survival mode, you do what you got to do. And, that is that they are now selling Bitcoin that is in their treasury. And as a matter of practice, will now be selling it into the market. So it's a reversal of what was a positive last year. It's a negative. I don't think it's a material negative, but it does underscore the significance of having, right? So 2 years from now, I guess actually it's 23 months from now, the number of Bitcoin mined daily will be cut in half. So presently it's 900 Bitcoin. As of May 24, it will become 450 Bitcoin. So that will reduce the amount of supply coming. And these halvings have historically sort of triggered, cyclical bull markets in Bitcoin. And so it's a short-term negative. It's a reversion to sort of, standard practice. I don't think it's that big a deal, but it would be better if they were in a position that they could continue to pursue this strategy of not selling all the Bitcoin that they mine. I mean, John, you've actually probably spent more time, certainly with the public miners recently than I have. I don't know if you have thoughts on that.
I mean, I think you're right. The public miners are now in a position where they're cash constrained. The capital markets closed on them. They're able to do some trade financing to pay for the servers that they deploy, but they're in a position now where capital spending objectives they set during the full flower of the bull market have been demolished. And the survival mode means in part that capital deployment is going to slow. It gets to be kind of complicated as to figuring out how that plays out on a global basis. We saw the global hash rate pull back very recently, which arguably should improve the return on capital outlook for the well-run miners, the ones that are not in cash distress, for example.
I want to go to a couple. Go ahead, John.
Well, I was just going to say it's really important that we have a vibrant mining community, right? But it's not necessarily important that it produce great returns in the public markets. What we need is enough miners to support the ecosystem. We have that in spades. We have that across many different countries, and the viability of that is not in question, and therefore the security and the whole premise of Bitcoin is well preserved.
I want to go to a couple audience questions before we wrap up. We had a question from Chris, came in a few minutes ago about, and you alluded to this earlier, Brett, but are there any other three arrows out there? Are there any other potential firms that in our dealings in this marketplace are taking excessive amounts of leverage or of significant enough size that they could cause, liquidations that would affect crypto markets? And then there's also a question around stablecoins. Somebody's asking whether the Gemini GUSD stablecoin is trustworthy. And you can look at the stablecoin market. Brett, do you have any concerns about something like Tether, which is a persistent source of FUD?
I'm sorry, what was the first question, John? I got to say
the general question. I'm going to consolidate the question for you.
Okay.
Are there any other investment firms Three Arrows that you're concerned about, or any stable coins like Tether that you're concerned about as the next great systemic risk that could weigh on crypto markets?
No, it's a good question. The two largest hedge funds, at least at the beginning of the year, were Multicoin and Polychain. They're down 70% plus this year, right? So they went from being over 4 billion probably to being $1 billion or less. Both funds don't use any leverage. So, they've reached the size where they're not that systemically important, and they wisely haven't used leverage. So they're in a position where, they can recover when things recover. I think there are going to be a few more blow-ups. There was one algorithmic stablecoin, so a stablecoin that is not backed by assets, but is backed by some type of a trading mechanism. It's USDD. It's about $600 million. There's some collateral behind it, so it's not as zero like Luna UST, but I think that's going to be a problem and will unwind to some extent. I think we feel very good about Circle. We as a firm are close to the folks at Circle. Anyone who doesn't worry about Tether, you should be a little bit worried just because it's so important to the ecosystem. And it hasn't been run in the kind of transparent way that I think we would all ideally like. And as a consequence, Circle, I think, is on a path to becoming the leading stablecoin, in the next year or two, because I think investors will opt for the greater comfort one can get. That being said, Tether has been tested, particularly in May when Luna UST melted down. There was an attack on Tether, and the peg held, and it's basically trading right at par, even in the midst of, these really tumultuous times in Bitcoin and the crypto market. So I would say it's not something that I'm worrying about on a day-to-day basis. I do keep an eye on it, and I have watched the market cap has gotten down, but I think that's, sort of assets leaving the ecosystem. I don't think it is necessarily something Tether specific. I was really heartened by how well it responded in May. But I guess I'll wrap by saying it is systemically important. It is too big to fail. And if it were to fail, it would set the ecosystem back years. The amount of damage that would be inflicted to parties ranging from Binance to FTX and otherwise. And so, distributing that risk more broadly across other stable coins in the coming years will strengthen the market, more. But I'm not worried about it. But you have to always have your eye on it.
All right, we're going to wrap it up there. Again, we want to do these SkyBridge Bitcoin reviews on a more regular basis, especially as markets are going through a volatile period, to continue to over-communicate around things that we're seeing in the marketplace. And we, I think, generally view this from an opportunistic mindset. We think both in private markets as we try to deploy more capital into that space, as well as the highest quality tokens in the marketplace offer a buying opportunity at these levels, and eager to talk about why, from a fundamental perspective, if you look at on-chain analysis, we believe that to be the case. Just a reminder, if we didn't get to one of your questions, there was a couple additional questions that I think best answered via email. Our email address is ir@skybridge.com, and we're happy to answer any questions at that address. But on behalf of John and Brett, thanks again for joining us for the SkyBridge Bitcoin review. We'll see you back here again soon.
Thank you, everybody. Thanks, John.